Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Ed Mills joins us of Raymond James. Ed, good morning to you, sir. It's good to see you once again.
Morning.
Let's get back to those tariffs. 25% tariff on autos, chips and pharmaceuticals, maybe as soon as early April. Ed, are you taking the president seriously and literally?
Yeah, I mean, I think what we'd say here is it's unlikely to be 25% off the bat. What we've seen with Canada, Mexico, and China, that whatever the market is focused on, that's probably is not what's going to be implemented. Is there something? Is it a 10% on semiconductors? Nothing that goes on pharmaceuticals in a study on autos? That would be probably my base case here, John. He likes to throw out really large numbers, something that forces trading partners to react and ultimately resets the bar. So if he comes in lower on any one of those threes or exclude any one of those threes, the market will take it as a win and he'll get the victory as well.
We also have the European Union's top trade official in Washington this week. Trump once again said there seems to be a deal on the table when it comes to Europe and their auto tariffs. Do you see this going for like, tariff for tariff between Brussels and Washington?
So I would expand kind of the European auto conversation beyond just tariffs. I think when I have had conversations with the experts in D.C. related to Europe, they say one of the big things about Europe is choosing a side. Is it going to be partnerships with the United States or partnerships with China? And so with the auto space, more joint ventures with U.S. car makers rather than joint ventures with Chinese car makers. Donald Trump sees the German kind of car makers having deals with the Chinese car makers as a national security concern of epic proportions. So part of that deal, in my mind, would be a recentering towards partnerships with the United States, investment in the United States. That's what gets him to back off the car tariffs on European counterparts.
It felt like when Trump was speaking yesterday, it was a bit loosey-goosey. In the neighborhood of 25%, probably April 2nd. So I have a list. March 4th, the pause on Canada and Mexico. That deadline is up. March 12th, the imports of aluminum and steel getting 25% hit. And then April 2nd, these auto tariffs. How much does Trump need to potentially punt so he can align the tariffs with the tax cuts that he's hoping his Congress can get in place?
Yeah, Anne-Marie, what I hear there is we're going to have weekly, if not daily at times, announcements on tariffs. He's going to keep us guessing, keep us informed. And part of this is a two-pronged attack as well. Number one, move the goalpost, force policy changes that he wants. And once he gets those achievements, he will celebrate that. Prong number two, by moving these dollar amounts in the percentages so high, if we don't get 25%, say we're at 5 or 10%, that is the foundation for a universal tariff that he actually wants. And he will say he's using that money to give Republicans the opportunity to pass tax cuts, do additional spending on key priorities. And so he is doing a both and strategy as it relates to what he's doing here, because he's moving the goalposts, resetting expectations, and going to get some policy wins out of it. And he will celebrate it in each step of the way.
So it sounds like he's in full-on negotiating mode. Then what will act as the revenue raisers?
Well, I think the ultimate revenue raiser is going to be that smaller than expected, but more permanent tariff that goes into effect. When we look back to the Canada, Mexico, China experiment, we were all focused on that 25%, but what was actually implemented was 10%, which looked like a better deal vis-a-vis everyone else. But that being set as a baseline for everything that's coming from China, I think is the base case as we set a baseline for the rest of the world. If he just said that outright, we'd all be freaked out. But if we start at 25%, he says he's going to go higher, but only settles at 10%, Anne-Marie, or maybe even less if he settles for 5%. That is the political cover for additional spending on Capitol Hill.
Ed, from your conversations with people in Washington, D.C. who cover trade, is there any consistent methodology to how these tariffs are being threatened or discussed, or is it basically just a flood the zone approach?
Lisa, it is a flood the zone approach. I've had very senior conversations with folks in the administration, and they've said a lot of this is do something so big and so bold that forces a policy response. And so last week when we got the reaction on reciprocal tariffs, the fact that we're including the value-added tax, currency manipulation, any regulation or anything that they want to include here shows me just how much they're going to use the force of the United States government, the military of the United States, the economy of the United States to threaten something so large that other countries have no choice but to respond in a way that Donald Trump wants you to respond. But then also having the ability to come in after that and lay down a universal tariff, it is kind of very interesting to watch. And I think it is kind of very transparent of exactly what they're trying to do here, Lisa.
That's on an international level. On a domestic level, is there any methodology that you can glean from some of the cuts that are being made more broadly across the government stemming from the DOGE effort that have been heralded by a lot of people?
Yeah, so on DOGE, you kind of the greater the cuts are, the more fanfare that those come, that's also providing political cover on the budget reconciliation bill. Because the more, if you are going to spend $4.5 trillion plus on extending out the 2017 tax cuts, if you want to spend an additional $300 billion on the military, on immigration, on energy, which is exactly what the Republicans want to do, they need something really big out there, like DOGE, like tariffs, to give them the political cover to say it is okay for us to do this because we are getting savings elsewhere. Again, resetting the bar, resetting the conversation. So what ultimately gets done seems like a compromise where in normal DC terms, that would be the main fight.
Ed, appreciate the framing. Thank you, sir. Ed Mills there of Raymond James. Subadra Rajappa of SocGen writing, the administration's focus on the 10-year yield and lowering borrowing costs should cap the rise in yields. They can reduce deficits, which they seem committed to doing through DOGE. Subadra joins us now for more. Subadra, good morning.
Good morning.
Is this just vibes or is this the real deal?
We'll find out over time because so far what we've heard from Besson is that they've had, Elon Musk and his team have found $50 billion in deficit savings from all of the work that they've put into it. But that's far from the $2 trillion that they're targeting in cutting spending from the federal government. So they have a long way to go to get to that target. So it'll be really interesting to see what they do, how they approach the savings on cuts in spending, as well as ways to change the way they issue so that they have control over where yields are, so that borrowing costs in general remain quite low for the investors.
There's an idea that's embedded in what you're saying, which is that the idea of the deficit in the United States has been driving the backup in yields that we saw at the end of last year. And what we've seen with the rally this year is an acceptance that maybe that deficit won't be as steep as people previously believed. Is that true? Is that sort of the base case of what's kind of being baked into this Treasury market?
So I'd say that 10-year Treasury yields are kind of stuck between a rock and a hard place. On the one hand, you have inflationary data that's pushing yields higher. You have a global environment where deficits, not just in the U.S. but globally, are expected to rise. I mean, Germany and all the other countries in Europe have to spend a lot more on defense. That's going to push their yields higher. So global bond yields should be moving higher. But on the other hand, you have this commitment almost from Treasury Secretary Besson, as well as from President Trump, that they're going to try to keep a lid on 10-year Treasury yields specifically. So that kind of keeps 10-year yields around that 4.5% level. So it's kind of this very interesting back and forth that you see in the bond market, where you see a rise towards 4.75.
How are they going to cap those yields? Is it going to be simply with the deficit, or is it going to be not selling 10-year treasuries? What's sort of the mechanism other than we care about that? Don't let those yields go higher.
So it's going to have to be a combination of things. One, they're going to have to try to rein in deficits. They're going to have to rein in spending. So maybe that's something that puts a lid on higher on 10-year Treasury yields, because a lot of the rise in Treasury yields has been because of higher term premia. So if there's less Treasury debt issuance, then that should cap the rise in Treasury yields. But there are also other mechanisms in which they can kind of cap the rise in yields. One is they're committed to producing more energy. Maybe that reduces headline inflation, so inflation expectations could come under pressure. That's another way that they're thinking about putting a lid on how high yields are going to move.
Do they edit the issuance?
That's very interesting. We'll have to see how that actually works out, because, as you guys were discussing, Bessent, before he became the Treasury Secretary, was actually, calling Yellen's issuance as a sort of activist Treasury issuance. So the question is whether they stick to the same type of plan where they issue a lot more in Treasury bills and not so much in coupon issuance. At least the initial indication seems to be that that's really where they're headed. And that's what the market was really focused on in the last refunding meeting, is that no change, I should say, in the forward guidance, which leads us to believe that they might keep coupon issuance sizes in the long end unchanged for the remainder of the year.
Rabini and Miran put out that paper at the end of last year. Miran's now in the administration and still no change. Maybe we'll get a change, I don't know. I want to understand when you think we start thinking about taxes a little bit more and a little bit less about tariffs and Deutsche. When does taxes really start to hit this market?
So the tax cuts, I think that they're going to try to pass first. I mean, whether it's one reconciliation bill or two is yet to be seen. That's going to, just the extension of the TCJA alone is going to add roughly $4 trillion increase in deficits. So they're going to have to find ways to offset those increases in deficits with spending cuts. And that's really where I think you're going to see a lot of pushback. Even among the Republicans in Congress, I think you're going to see pushbacks to spending cuts, because it's going to hit their own district, and they're going to try to have to think hard before they agree to the tax deal.
If you ask Secretary Bessent his number one priority for this year, he will say extending TCJA. We've heard that from him. We've had a whole conversation about the bond market and not talked about the Fed. Are the Fed minutes worth looking at later on this afternoon?
Absolutely, because they will maybe, actually, let me dial that back. They might be, because people are hoping that perhaps they'll shed some light on how the new policies and the policy uncertainty is factoring into Fed officials' views on inflation, et cetera. I say maybe not, because
you're taking it back.
Maybe
just
they won't say anything, and they'll just say, we have to wait and see, and it won't be more clarity.
Should Lisa reschedule that nap?
Yes, she should, because I think that you could get some nuggets of information on what they're thinking about, how long they want to stay on pause.
I said that.
As well as on QT.
Yeah.
And then
any changes to QT?
Well, there is a possibility that it's also going to be pretty opaque and not say anything. But, I'm not going to nap. I'm going to be there. I'm going to be reading it.
Special coverage from Bramo. Tune in later on this afternoon on Bloomberg TV. Subadra, appreciate it.
Thank you.
It's good to see you. Thank you. Subadra Rajappa there of Societe Generale. As Young Thomas of SoFi seeing broader opportunities ahead, writing, the US is not the only game and tech is not the only game. Don't miss opportunities because you're stuck staring at the same groups that padded your portfolio up until this point. Liz joins us now for more. Liz, welcome to the program. We're all looking at Europe. Massive outperformance there. The financials, the banks on a stock 600 up by close to 18%. Liz, what's your advice this morning for people watching this program that might have missed it? What should they do now?
Well, I don't think you've missed it, and in a sense that we've been waiting for Europe to come back for the better part of 15 years now, and the debate has really been, is Europe cheaper than the U.S. for a reason? And I think the answer to that for a long time was yes. The thing that I've actually been focusing on more than Europe is China, and if you look at the opportunities in China and even just some of the larger ETFs out of China, the Internet ETF and the large cap ETF doing much, much better than the S&P, and actually the Internet ETF even outperforming outperforming the European ETF. So the point here being that we've had this era where everybody has focused so much on the U.S., and rightfully so. We've had 2 full years of over 20% returns in the S&P, led mostly by technology, communications, discretionary, all the usual suspects that we know about. And now we're getting to a point where we've got central banks moving in some different directions. We've got steady fundamentals in the U.S. economically and on an earnings perspective, but now we have other regions perking up, and China in particular showing commitment to really stimulating their economy until they get what they want, which is to meet their growth numbers.
So Liz, let's talk about China a little bit more. On the data front overnight, home prices not as bad as some people might have thought, signs of stabilization there. We heard from a miner, BHP Billiton, earlier this week. They talked about green shoots. Heard from a hotel group in the last 24 hours, IHG, who talked about maybe China bottoming out as well. Liz, with all of that in mind, how do you think people should play the China story when maybe they've tried to get in before and been burnt several times?
Yeah, I mean, I think that's happened to people in China and in Europe, so I understand the feeling. And it's happened to me in Europe, too. I tried to get in a few years ago and got burned. It went nowhere. So I understand the bruises that I think investors have taken. And make no mistake, China still has progress to make. They still have problems over there, and the stimulus that they've announced so far has not been entirely successful at stimulating what they need to, which is the consumer portion of their economy and to save the real estate portion of their economy. So I still think more needs to be done, but I do think we will hear more from them. As we start to get news of perhaps stimulus that targets the consumer directly or that targets the real estate sector directly, I think that's where you see things really perk up in a durable fashion. We've already seen some volatility in the Chinese markets after the stimulus that was announced last fall. We saw this big surge in a lot of those stocks and then kind of a fall off afterwards. I actually believe China bottomed before that. So bottoming, as we know, is a process. It's not just a moment in time. And China had been going through what I believe to be a bottoming process before that first round of stimulus was announced. Now, that first round of stimulus, again, was not entirely effective. They had to announce some more, and I still believe they'll have more to come. But I think we're on the way to finding out that things are getting a little bit better there. And if not, they will get the support that they need from the government.
One of the reasons why a lot of people have said that China is uninvestable is because the policy structure is less clear there in terms of how much they champion their businesses. And you add on top of that a very deliberate effort by the United States to isolate China and interrupt some of the supply chains. How do you discount those types of just structural arguments against investing in China right now?
Yeah, so when we issued our 2025 outlook, this was in mid-December, we had China listed as a contrarian play for obvious reasons. We knew that the new administration would go after China and perhaps increase the tariffs that were already in place. So I want to be very clear, this is not something where I'm saying, we're investing in China and we're bullish on China for a 10 to 15-year period. This is something where if you're looking at your investment portfolio and you are, much like many investors, overweight U.S. technology, overweight all of the stuff that got us to this point, it's time to start looking outside of those baskets. And some of that might be still in the U.S., in other sectors in the U.S. that have not kept pace, things like healthcare, financials, industrials, things that are showing good earnings growth, even some of the communications names that are not so much in the headlines as usual, but then also looking outside the U.S., because another contrarian viewpoint coming into this year was that the U.S. would actually underperform international. So that includes things like China, and if you're getting it at a really nice discount, getting it pretty cheap compared to U.S. stocks, and things like Europe also getting pretty cheap compared to U.S. stocks. Valuations are very important in an environment where yields have remained high and are expected to stay high because of the sticky inflation for the foreseeable future.
Liz, a lot of people were talking about this last year, at the beginning of last year, that tech would underperform and that everything else would catch up. It seems like people are reviving that concept now because of some similar and some different arguments. Why is it this year that people are going to step away from tech giants that have been hit or miss more generally, but still are at the epicenter of a transition that a lot of people seem to have faith in?
Well, first of all, you think about just the timeline of events, right? I mentioned before we've had 2 full years of above 20% returns in the S&P. If you just look at that over a historical context, usually when you have that strong of performance 2 years in a row, the third year is still positive on average, but not nearly as positive. So we would expect something more like normal returns this year. Let's call that high single digits, low double digits. So that's part of it, right? It can't continue forever. The other part of it is that a lot of what drove tech to this point was the semiconductor play and the theme of AI coming to life. We are still very much in the infancy of that theme, but I think we are transitioning into one of the next phases, and that next phase is going to take us towards other types of companies. In the U.S., if we're looking at just technology in the U.S., I'm actually more bullish on software and things like cybersecurity than on semiconductors this year, because I do think that we're making that transition. The other part of that transition is that competition rises. So if we're looking at other types of companies, and obviously we know about the news that came out of China a few weeks ago on DeepSeek, if we're looking at other types of companies, there's bound to be heightened competition around the globe. Other companies, other regions are going to get in on this game, and we're going to have to watch for opportunities outside of the ones that we've been focusing on up until this point.
Certainly seeing that to start 2025. Liz, appreciate your time. Liz Young-Thomas there of SoFi. Luzzetti of Deutsche Bank, writing, while we continue to think the next move is a cut rather than a hike, recent events have raised the possibility that the Fed needs to hike rates in the second half of this year. Matt joins us now for more. Matt, it's good to see you.
Good to see you.
It's not your base case, but the chance isn't zero and the chance went up. So let's talk about why and how high that bar is for that hike.
Yeah, I think to be clear, I think that the bar is high. I think that the Fed, the next move is very much likely to be a cut. I think to get there, you need 3 things to happen. One, the labor market needs to become a source of inflationary pressures again. The latest batch of data that we've had on the labor market sees the unemployment rate going down, wage growth a little bit higher, payroll gains picking back up. And so the labor market is not as much of a source of downside risk as it once was. You need to see inflationary pressures picking up and accelerating. The latest data there was a little bit mixed. We saw the CPI report, which was much higher than anticipated, but that didn't feed through to the PCE data. But at the same time, we have tariff threats out there that are more than we were anticipating, and so the inflation threat is greater than we were anticipating. The third thing is inflation expectations, and the Fed is always highly focused on those. And there you have seen some upward movement. The latest University of Michigan data has moved higher, including at the short end, inflation expectations. Latest survey of professional forecasters has moved a little bit higher. So just at the margin, I think that we've seen the risk of a rate hike increase for the second half of the year.
I wonder if in the meantime, if we're not talking about a hike, are we talking about a Federal Reserve that has accepted inflation at about 3% or 2.8%, given the fact that it's been 46 months since inflation has been below that 2% target that the Fed has?
It's quite remarkable. If you go back to their December SEP, they don't expect inflation to get down to 2% until 2027. That is an extraordinarily long period of time. But I think that they're telling you as well, they're not accepting the trade-offs between the labor market and getting inflation down to 2% quicker, right? So they have a 2.5% core PCE inflation forecast this year, just like us. We think that they will hold steady with their policy rate this year in order to help to bring inflation down to target over time. But yeah, to a certain extent, they are accepting of inflation that's called 0.5% that's above their target, because they would not think that would want to trigger an unemployment rate that rises by a few tenths in order to get it down quicker.
Is it enough for them to just remain on hold to get inflation on that gradual path back to 2%? Or do they have any control whatsoever over this, given that a lot of it has to do with variables well outside their parameters?
Yeah. I think if it weren't for all the policy risks out there about immigration and fiscal policy and tariffs, which is obviously a lot of risks that are really important for them, that yes, I think there was a disinflationary trend in place. We were seeing rental inflation coming down, and I would have confidence that we'd get within a 0.25 percentage point of their target this year. But those risks are meaningful. They're certainly lifting inflation, we think, this year, potentially next year. And I think that will require them having to remain on hold for a period of time here. I think for the minutes today, it'll be an interesting question how they talk about how restrictive policy is. At the January FOMC meeting, Chair Powell said that they were meaningfully restrictive. I think you've heard a lot of uncertainty from a number of other officials. Even John Williams was talking about they were only modestly restrictive. A number of officials think that they're near neutral at this point in time, which we agree with. So I think that's an area where there's just a lot of disagreement on the committee at this point.
What would it take to raise rates? You're talking about this uncertainty that the Fed is going to price in potentially stickier inflation from tariffs, immigration policy. What would it take for the Fed to say, actually, now's time for a hike?
Yeah, I think you need two things and then the third wild card. The first thing is that the labor market needs to retighten. So I think you need the unemployment rate to be falling below 4%, the quits rate rising, wage growth re-accelerating. So the labor market is not just, there's not downside risk, but it's actually a new source of inflationary pressures. Two, inflation itself has to accelerate. So I think core PCE has to be going to 3% or above. They've been pretty clear that if inflation is just stalling out, they meet that with keeping policy on hold. And then the third thing will always be inflation expectations. If those are rising, it lowers the bar on those two other things, and they could have to raise rates if inflation expectations move higher.
BNP Paribas put out a note yesterday and said this Federal Reserve was comfortably numb, comfortable doing nothing. And I think you might agree with that. And what I want to understand, as they're in this period of doing nothing, how balanced are the risks? Are they balanced to the downside as they are to the upside? Is there a real risk that things could get worse as they sit there and do nothing, waiting to see the policy changes that may or may not come from Washington, D.C.?
Look, I think we have an economy that is entering this period with a lot of momentum. You know, growth last year, the consumer growth last year was strong. Consumer spending above 3%, 4.2% in Q4. The labor market was accelerating in many ways. We've seen payroll gains on a 3-month moving average basis above 200,000. Leading indicators were supportive, credit conditions, financial conditions, optimism from businesses, CEO, and other surveys hitting several-year highs. So the economy had meaningful forward-looking momentum that is being met with a lot of uncertainty. And I think that they should be somewhat concerned that the kind of constant tariff threats, where we're hearing from a fiscal spending perspective, can turn sentiment relatively quickly if they continue to persist, and if it's not counteracted by other positive news on the economy, deregulation, fiscal policy, tax cuts. And so I think the administration probably has to balance that out a bit more.
How quickly do you think we could see some of the job cuts in Washington show up in the economic data? Is it too early?
No, if you look at the weekly jobless claims and you look at the D.C. area, it's already showing up. It was showing up in the past 2 weeks, and I would expect that accelerates. Many of these cuts look like they might be coming after the survey week for the February jobs report, so it might take until the March jobs report to get greater evidence of that. And then we have this whole batch that took the buyouts, which that probably does not show up until the September-October data because they are kept on payrolls until that period.
Do you know what it could potentially average out to? Because last year, when you look at federal workers added to the NFP, it was about north of 35,000 individuals a month. What kind of number could we see every month going forward?
Look, they've had a target of about 10% of the workforce. We think about having about 2.4 million federal workers. Say that's 200,000 jobs. So that is a meaningful hit to payroll gains if and when it happens. The numbers are much smaller than that are being reported so far, and the numbers that kind of took the buyout, maybe 60 or 70,000 individuals, and that doesn't impact the data until later. But look, it's a meaningful amount to payroll gains when it happens, and if it is as big as kind of being that's being focused on. I would just also indicate in the near term, those buyouts could actually lift payrolls a little bit. Those individuals could get another job as they're currently on government. There's actually seasonality here where people would typically be retiring, but they won't because they're kept on payrolls. So over the next 6, 7, 8 months, you could actually have some counteracting forces from a seasonal perspective.
That's a great counterpoint to think about. Matt, appreciate your time as always.
Thank you.
Matt Luzzetti there of Deutsche Bank.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.